Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So, before we get started, have you ever seen this video on Key and Peele about how Jaden Smith chooses a role? Well, basically, um, it just kind of highlights of how out of touch he is. So when he talks about, yeah, in the script, they go to a supermarket. Like, supermarket? What's that? Oh, it's like a mansion where you go to get food. And I think that's happening to me now, right? So as I've paid off debt, you kind of see here in the screenshot, I paid off my mortgage under 3 years, right? 2051 is the 30-year date. Subtract 30, 2021 is when I bought the house. July 29, 2024, paid off. And so nowadays, when I watch like TikToks of young people talking about how they're struggling financially and they're in their early 20s, I'm like, hey, that's a pretty good act, right? And then I realized, like, no, it's actually true, and I've become like Jaden Smith in the Key and Peele skit, you know? And so that's really unfortunate, and that's kind of like a side effect of having your debt, like your mortgage, paid off, because now your life is just in easy mode, and you won't be able to relate with other people anymore. It's like, oh yeah, you don't have a paid off mortgage in 3 years, and it's like, huh, interesting. Supermarket? What's that? Oh, a mansion where the butlers go to get food? So, all right, well, let's get to it. So, what we're going to do today is just what we do every single other day, which is another review of velocity banking. All it is a debt payoff strategy using a line of credit as your main operating account. Are results guaranteed? No, I don't guarantee any results. So, I'll just say results not typical. None of you will probably pay off a mortgage in 3 years. Um, but yeah, let's just get to it. So, yeah, like I said before, it's just a debt payoff strategy using your line of credit as your main operating account, and there's really only two things you need. Number one's a budget. Number two is a line of credit as your main operating account. I now repeat that, but this is incredibly important that a lot of people don't understand because people get lines of credit, like home equity lines of credit, and then I see posts on Reddit like, why am I struggling with a home equity line of credit? Because you're not using it as your main operating account, right? And there's really two things that we assume when we do velocity banking. Number one is we make the same income, and then number two, this is where the part of making your main operating account comes in, is that we don't have any savings, right? And so we freak out about our savings. We freak out about that, and if it's to zero, because go ahead and tell your friends and family, like, hey, like, I don't have any I haven't had any savings. It's been zero for like the past 2 years, and watch them like say, oh, interesting. How does that work? Rather than like, are you insane? That's kind of, my mom did that to me when I visited home last year in California. But let's go ahead and get to it. All right, so now, um, yeah, so instead of savings, we have a number called cash flow, which looks like savings, but we got to make our line of credit as our main operating account. And so what is a line of credit? All it is a financial tool where you could borrow money, pay it back, and then use it over and over again. That's all a line of credit is. And again, you can just do a Google search, personal lines of credit. If you got a business, look for a business line of credit, home equity line of credit, like do a search on those and notice that they all have the term line of credit within the product name. Credit cards are a type of line of credit, and I got all of them. In fact, right now, I got over $270,000 in lines of credit, and then by the end of the month, I'm going to have over 500. So let's just assume that we have access. And actually, let me restart this because I think I did this previously on a practice run. But let's assume that we have access to maybe about a $40,000 or $38,000 personal line of credit. And then, these personal lines of credit, they kind of look something like this, where it's like credit bill 15,000. You go to the bank's website and then you click a button. It's like, well, blam, you got the money in your checking account and they're charging you an interest rate, right? So we have here a home equity line of credit. I've been approved for this. So basically, all that means is that um, I can borrow up to $280,000 and put in my checking account, and then the credit union is going to charge me 8.5%, right? And again, I practice what I preach. So when money comes in, the beginning balance is zero. I get all this money and then I dump it into the line of credit and the pending balance is zero, right? And so, yeah, I mean, most people they'll be like, "You need 3 to 6 months of savings." I'm like, what are you talking about? Anyways, here's the secret of getting to line of credit, and I say this in every single video, and people try to bypass this, thinking like they're smarter than the banks, and the banks know that most of their applications are fraudulent. In fact, once upon a time, I took a business credit class taught by a very knowledgeable instructor, and the instructor said, yeah, 90% of business credit applications are fraudulent. 90%. So the banks want to lend to everybody, but most people are not credible. So here's the thing, don't be that 90% that tries to defraud the bank. Actually try to be credible, right? And the secret to lending is that banks don't lend money to people who need it, right? Like people try to fight that, and I say, don't fight it. That's how I got over $500,000 in lines of credit because I understood the secret of getting credit, which is don't get it when you need it, right? So let's go ahead and move this credit card debt. So it's 5, 8, 15. I think I got it 28,000. All right, so let's move that 28,000 into here, 28,000. And then guess what happens to these credit cards by simply moving this 28,000, right? These payments go away, 000. And it's like, whoa, we went from 1,200, which is pretty good because most Americans can't even make a 1,400, like a $400 emergency, like $400. Like, whoa, my car broke down. That's probably going to cost you a couple grand, right? To $2,000, and then now what we moved some debt after we moved some debt into the line of credit. Okay, we put our entire paycheck into the line of credit, and then we take our expenses out of the line of credit, right? That's how we make it our main operating account. And then after every single month, the balance is going to go down by our cash flow plus some interest, right? The interest on the line of credit, which we always like to calculate separately because it's so much easier to do that. And then to calculate it, it's G2 plus H2. So the previous month's balance, or the next month's balance, is always the previous month's plus the previous month's interest minus our cash flow. So what is our cash flow? It is 2147.99. 2147.99. Okay, so let's go ahead and do this. And we're going to take the average of these two numbers, multiply it by the interest rate, which is 0.15, and then divide by 12 because interest rate's quoted annually, but the interest is calculated monthly, which is why you divide by 12, right? And as you can see right here, and for this personal line of credit that I have, I barely even use it. You see the amount due is zero, and I probably do need to use it or else they'll close it probably. Interest rate is about 15%, right? 15% is the interest rate. And so usually with home equity lines, it's like 8 to 10. But just for example, we'll assume that we have a good personal line of credit available from a credit union. I think it should be about 15%. And then what we do is just copy these numbers, and then they'll show us how long it takes us to pay off this personal line of credit, these credit cards. So why do we start with the credit cards? Because they have the highest interest rate and they take up the most cash flow. And interest rate does have a correlation with the cash flow, but there are other factors that determine how much cash flow it takes a payment, or sorry, a debt does take up, right? And so let me go back here. So 15 months, and then let's go ahead and do that. And then that's going to be, what is that? 38K, right? I think it's 38. Let me just quickly. 28? Did I screw up? Hold on. No, it's 28, right? I think. 28. Hopefully I didn't screw up. Someone pointed it out to me. Didn't you screw up on your calculation? I'm like, yeah, I did. So let me just verify one more time. Plus 15. Yeah, 28K. So these three credit cards gone a little bit after a year. And then now we got an auto loan, a personal loan, and a mortgage. Have you ever seen these interest rates on personal loans? Like I was going to the Discover website. You take a look here. Like I don't know if you can see this, but let me just kind of zoom in. Like 17% APR for 60 months and a 740 credit score. So I mean, if this is the APR, that means people are actually taking loans at those rates, right? And I've seen people take out like short-term loans at like 30% interest. And I'm like, whoa, right? Like, what are we doing here? So, well, I just threw in a personal loan at 70% in the mix, and then I just kind of copied these, and we assume that we have a mortgage for 210. Now, the unrealistic thing about all this is that we're assuming that this is all new fresh debt at once, and I don't think any lender will allow you to get like, oh, three credit cards, an auto loan, a personal mortgage like on the same month. You know what I mean? Like they'll be like, "What's up with that?" and then deny you because they always want you to get credit when you're stable rather than getting all like five fresh new debts all in the same month, right? So let's go ahead and focus on this. So let's see what the balances are on these three loans, which is after 15 months. So take a look here. We have this cool loan calculator right here. Okay. So let's type in the current month, which is 15, 15, 15. And then you could see how much interest we've already paid. Take a look at this, 4 grand on that personal loan. And we paid 17% interest, right? So interest is one of the factors that determine the payment, but also, actually these three factors are all important. The balance, the interest rate, and the term, they affect the payment, right? Someone wrote a comment like the payment is arbitrary, and for amortized loans, they are not, right? There's a formula for this. That's why this payment function exists. And so, if you have these three terms, you can automatically determine the payment amount. Now, we have something called the cash flow index as well. And so the lower this number, those are the debts that you want to pay off. And so think about this, right? If I pay off this 16 grand, I get $500 of cash flow back, almost 500. But in order to get this $800 of cash flow, I have to pay way more than that in this $200,000 loan. So this is why like loans where the cash flow index is above 100, and again, if you want a better explanation, look it up in Google, are to be paid off last, but we do have to pay them off, right? So we pay these off first, get this about like almost $1,000 of cash flow back, and then we pay this off because if we never pay it off, uh, let's say we take the full loan to the full term to 360 months, which is 30 years, well, blam, you pay 50% interest on this $200,000 loan, right? So a lot of people don't know that. They see the 3%, like, that's so cheap. Now, again, if $100,000 in the course of 30 years is, I guess it's okay. But you ever see, like, in home negotiations, how people are so, like, uh, you know, they get so crazy over like a $5,000 to $10,000 discount, but like, they don't mind paying a bank like 50%. That's the part that blows my mind. So let me go ahead here and let's do this, right? These usually the general rule of thumb is that if it's below 50, the cash flow index, it's okay to pay it off. So let's go ahead and pay off these two loans. And usually if it's in the 30 range, 30, 40, I like seeing that. And let's go ahead and sum this up. Okay, I'm going to go ahead and sum this up. And then now the two loans equal about 35 grand, right? 35 grand. So let's go ahead and move this 35 grand into our line of credit right here. And we're going to go ahead and do that. And so now plus 35,164.39, right? And so if we move this 35 grand here, what's going to happen, okay, and we have a $38,000 limit, so we can, and I purposely chose this number just because I knew I could move this 35 grand into this line of credit. If we don't have enough room, this is why you want the biggest line of credit available so that you have ultimate flexibility, whereas if you don't have a huge line of credit, then life becomes a lot harder. But by moving this 38 grand, 35 grand, guess what happens to these two payments, the auto and the personal? 0, 0, well, blam, right? And so now in 15 months, we increased our cash flow to $3,114.63. So let's go ahead and move that here. And let me go back here and let's go ahead and do this. And so let's go ahead and do 3114.63. That's our new cash flow. And then just copy and paste this and do this and this and this, and then as you can see in 26 months, well, blam, it's paid off. It's my new catchphrase. Wablam. I don't even know where I got it from. Kapow. Maybe I gotta look at like those old Batman TV series where like in the intro they got wham, bow, kapow, Kelly Kapowski. No, I'm just kidding. So let's go ahead and now we completely paid off this auto loan and personal loan in about 26 months. 26 months. And then now we need to add these two, so it's 46. So what's 28 plus 46? That is 74K. Okay. So now let's go ahead and do 74K, and it includes these two loans, and now we attack the mortgage. Now this is going to be easy street, right? So let's just take a look here. And so now what we're going to do is with the mortgage, okay, we don't need to replace it with the line of credit. In fact, our line of credit right now is only about 38 grand. This is the least important part that people get really hung up about. Like, if you transfer some of the principal into the line of credit, you can easily pay it off with your cash flow. So what do I mean by that? So let's say, let's take a look here at 26 months. What's the balance of the mortgage? So let's say it's $200,000, and then we move $10,000, a small amount, into the line of credit. So we'll move 10,000, okay, plus 10000. Okay, cash flow is the same, right? Because the loan hasn't been paid off yet. And how long is it going to take us to pay that 10,000? 2, oh my goodness, 3 months, right? But in order for us to pay this 10,000, this took more than 2 years, right? 26 months is like 2 years and 2 months. Okay, so that's the idea of using your line of credit as a way to pay off your mortgage. But okay, here's the thing, right? You don't have to transfer that much, and people get so hung up about this. But what's really important about paying off your mortgage is that you pay it off last, because you need to recover the other cash flow that's sucking up, or pay off the other debts that's sucking up your cash flow first, right? Whereas this one's not taking up our cash flow, and then once we've recovered, as maximize our cash flow, saying cash flow like 20 times in the last 20 seconds, um, we pay it off, right? And why would we use a line of credit instead of doing direct extra payments? Well, think about this, right? Most people, even if they have savings, and I know people like this, are not going to put it in the line of credit. They're just not going to, right? Like, they're not going to do it. I'm not in the line of credit. I'm sorry, let me rephrase that again. So why don't most people directly put their extra cash into the loans? Because the loan is essentially a one-way street. Like, if I put that extra 3,100 something dollars into the loan, it's basically gone, right? Especially like a big mortgage. So what if you need it for emergencies? Now, here's the other thing too. People say, well, why don't you just use your credit card or line of credit as your backup? You can certainly do that. But most people, if they have their finances kind of tangled in a web, they just kind of do nothing, right? And the big value in doing this chunking strategy is that once you've done like a small chunk, and I know this sounds kind of stupid, but it's actually true, is that you're actually going to put your entire paycheck into the line of credit. Like, in a sense, you're actually gonna do it. So have you ever like heard a phrase or saying where it's like, hey, you know what the best real estate investing strategy is? The one that you're actually going to do, right? So what happens is a lot of people, they study so much real estate investing and know all the strategies, and then they know all, like, oh, sub 2 contract for deed, blah 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 blah, and then they're so knowledgeable and book smart, but they don't actually do it, right? And that's what happens with a lot of people when it comes to paying off debt. Yeah, I know what I need to do. I need to do a budget and blah blah blah, and then it becomes all tangled up and complicated, and they get overwhelmed and they don't do it, right? Whereas if I just, I don't know, transfer some of that principal into the line of credit and then use it in my main operating account, I actually don't have to be that disciplined because I'm just working on the law of averages. Some months I'll have more expenses than less months. I've had negative cash flow months, but overall, I've turned out to be positive, right? So we have to kind of take a look at the big picture. And what happens is that people they think that they can calculate this cash flow like to the T month to month when your cash flow is actually variable. I mean, ask anybody with a rental property who has that $200 a month cash flow, okay? And then realize that that $200 a month cash flow isn't actually cash flow once the HVAC goes out. So that's basically why I say this is the least important part of paying off the debt, because you could do it so many ways where you, okay, direct cash into a loan, that's fine, but why not just make it easy on yourself where you don't have to calculate the exact amount you're going to put into the loan, and if you know if you ever need that money back, right? Like it's kind of gone. I mean, it's there, but it's kind of gone. And then if you use your lines of credit or your credit cards as your backup, that's when you engage in that thing that we kind of look down upon, which is segregation of income, which is why most landlords are broke, right? So like most landlords, if you ever seen like the simulations or calculations we've done, pay off their rental property in about like 4 years. In the ones that we've done, right? So just throwing that out there. Now, let's just finish this off and whip out that velocity banking calculator that we always love to show off. And so let me just kind of go right here. And let me go in here. Where are we? Okay. So what is this velocity banking calculator? Well, it's provided by Renatus. And this is where I originally learned velocity banking from. Go ahead and type in myrenatus.com in Google. And not only do you learn velocity banking, you learn about all this other cool stuff. Like, this is where I learned how to buy properties at a discount. This is where I learned how to not make rookie mistakes, real estate red flags. This is where I learned negotiations. You have to learn a little bit of empathy and create win-win situations for your buyers and sellers and anybody that you interact with, right? A lot of stuff in there, and all people want to do, and I'm not really kidding, I'm not kidding about this, where it's like, I just want to learn velocity banking. And oh, I'm like, well, you just told me that you got out of debt and then you got into it again, and so velocity banking is just one of the tools in the toolbox. Learn some other stuff. And why am I say that? Because I got an agenda to make some sales commission off of selling Renata's products, because this whole thing is a sales funnel, right? You ever have anyone just openly admit that to you? Well, I'm not trying to hide my intentions, right? So, okay. Full disclosure, I am an independent contracted marketer, so I do sell the education, and I make a commission off of it. Now, let's go ahead and fill in the deets or the details of that mortgage. So the original balance is going to be 210,000. What's the current balance right now? Let me look at my other screen. It is 200,331.68. 200,331.68, right? What is the interest rate? So let me take a look right here. The interest rate is 3%, 30 years, and then what's the actual payment? 885.37, and the interest rate is 15%. And then our expenses is 2,000, but I don't think our income is right. Our income is $6,000. Yes, $6,000. So let me go ahead and do that. Okay. And so you see that it takes us 4.6 years to pay off. Now, I always recommend, just kind of like as a rule of thumb, just you can just chunk the around your paycheck. So moving around 6,500 should be fine. And let's take a look here what the actual difference is by lowering that chunk amount 6,500, and then we see that we save about $1,000 of interest. Now, I'm going to tell you something. With this chunking strategy, the line of credit interest, or I'm just talking about using your line of credit to pay an amortized mortgage, the interest rate does matter, which is why you don't want to do huge amounts, right? Again, this is for preventing segregation of income and making it easy to pay off your mortgage, right? Making it easy. Easy has a lot of value, right? Just because something is cheap doesn't mean that you're going to get a lot of value out of it. And I always make that analogy about how, hey, you got a Netflix account that's $199 per month, and I forget what the current rates are. It's like 13 or whatever, but it's like $199 per month, but you can only watch from 1 a.m. to 6 a.m. Right? Would you use it? Would you get any value out of it? Probably not. Same thing with these loans too, where hey, yeah, we'll give you a cheap interest rate, but you can never pull out the money that you put in. right? So we're okay with paying these higher interest rates, but we just have to use them effectively. And the last thing that we never want to do, or the thing that we never want to do for sure, is replace our mortgage with the line of credit, because this is when the interest rate actually does matter, right? So I replace it and take a look at this. Yeah, I paid off in 6.7 years, but I actually paid 23 grand more if I put in a 15% line of credit, right? 23 grand more. And so if I were the bank, I would love this situation because I thought it was going to take me 30 years to get this 95 grand back, or 95 grand in interest, but you gave me not only this 95 grand, but an extra 23 in like 25 years, right? So like, or you sped up the time frame. Like, dude, I love this. I love you if you replace your mortgage with a higher interest rate line of credit. Now, the only time that I would think it would work is when the interest rate is comparable. So, for example, if this is a 3, which will never happen with a line of credit, or almost never, then you can see the money is saved there, right? So about 14 grand. But let's take a look at this. If I do a $15,000 chunk, or not $15,000, $6,500 chunk at, let's say, 15% interest rate, it barely makes a difference, like 2 grand, whoop-de-doo, right? so so the interest rate when you do chunking matters, but it really doesn't, right? Like it really does not matter that much, although you always want the lowest interest rate. So for example, in my home equity line of credit, the interest rate is 8.5%, and you can see that, oh, well, I saved like a grand. You know what I mean? But it's really, this is the most fascinating part to me about how the interest rate doesn't really affect it when you do like small chunks, right? Whereas if I do replace the whole mortgage, okay, and then this really does affect uh, the outcome of paying off the debt. So let me just kind of, and again, no one's going to give you a 3% interest rate. Now, if I had an investment mortgage at 8, I probably could justify. And actually, let me see what 3.5 does. How much of a difference 3.5 makes? Ooh, 2 grand. And if I do 4, yeah, see that? So even a 1% interest rate makes a difference when you replace the mortgage. That's amazing. Okay, so now let's go back here. And so now this 4.5 years, okay, now we're going to go back into our spreadsheet here and then go ahead and write that down. And so let's go here. So 26 divided by 12 plus 4.5. That's 6.67 years, and we're debt free. All right. So that's $282,000 of debt. And now you got life on easy mode, right? So life will just be so much easier when you're debt free, 4 grand a month. Oh my goodness. That is so easy. And you see those videos of people struggling on TikTok. You know why I only remember? Because I was there for a period of my life, so I have this memory. Yeah, I was there, but now I'm like at my stage where it's like, oh yeah, I got to pay off mortgage. I'm like, what are you acting? I'm like Jaden Smith in the Key and Peele skit, like, hey, that's a good joke, and it's like, oh wait, that's actually real. Like I can't believe that people. Yeah, I remember that people are struggling because I did so too. But that's kind of it. You have a higher level of problems of not being able to relate, but I would rather be in that camp rather than like be, graduating college. And here's the thing. This is why, like, I don't understand why people don't want family support systems, right? Like if I had people in my life saying, "Hey man, um if S hits the fan, if crap hits the fan, just always know that you got a safety net. We'll always be there for you." But do you think families tell each other that nowadays? I feel like they don't. It's just like, oh, you do your own thing, and I'll do my own thing, and everything's like disconnected, right? But then, like, you ever notice that the biggest companies and enterprises that control the world are like family-owned businesses, like the Rockefellers? Like they own everything from like the universities to the banks to oil. Like they got their hand in everything, and they're the wealthiest from generation to generation. But the way that they society trains you is like just be a hardworking individual. Like don't create your little family safety net and help other people out in their time of need. Just be a hardworking individual. And then like the richest families in the world kind of follow the exact opposite like philosophy that we're going to take care of our families generation to generation. Kind of sad, right? Like I don't know what to say, but people are stupid. Like I know that seems kind of like harsh, but when I see people struggling, I always like give them the most easiest advice that they take, and then they think they're better than me, and then and then I just see them struggle. Like happen, it's like the episode of Seinfeld where Jerry tries to help the tennis pro shop owner, and then like he purposely loses on tennis to make the pro shop owner look good, and then the pro shop owner gets cocky, and so now Jerry has to like actually play tennis at his real level because the pro shop owner just wasn't a little bit humble that Jerry was helping him out. That's why I feel like where society is today. It's like a no-win situation. Anyways, I feel like I've rambled too much enough. This is a Korean Atlanta mentorship. So what's the point of this video? Man, life is going to be on easy mode when you have debt paid off using velocity banking. All right, well, that's it for today. Have a great day, and we'll speak next time.